ASTS Space Mobile is one of the most innovative companies on the planet right now. Well, can we even say they're on the planet? Some of their businesses outside of the planet in space as they're launching satellites to help improve communication technology. And if you're interested in this stock, I've done some digging here and I found some things that you need to know about this company before you make your decision on buying or selling the stock. So I'm going to share with you some information and some insights that you can utilize to make your decision about this company. So one of the things I found to be important is how this company is being impacted by tariffs. The management team said that their average capital cost, including direct materials, launch costs for their constellation over the 90 Block 2 Bluebird satellites, will fall in the range of $21 to $23 million per satellite. So they plan to have about 90 of these Block 2 Bluebird satellites, and each one will cost them roughly $22 million per satellite. But this is higher than their previous estimate of roughly 20 million each satellite. So the costs have increased by roughly 10%. And it's primarily driven by higher launch costs from their announced near-term schedule, as well as higher direct materials cost due to the recently announced tariffs. So the tariffs are having an impact on ASTS Space Mobile. To build the components to build these satellites, they need a lot of components, and they're importing some of those components, and their costs of goods will increase, and thereby increasing the overall cost by roughly 10% from 20 million to 22 million at the midpoint. Not a huge increase, but a meaningful increase. The company, as we'll discuss in a little bit, the management team said still, even with the higher cost, they're still, their estimates to become profitable at a certain number of satellite launches remains intact. And here's that comment from the management team. We reiterate our belief that the operation of about 25 of these satellites will enable us to potentially generate cash flows from operating activities. So in other words, being either break even or positive in cash flow from operations, which is a critical inflection point, because from that point onward, they will be significantly less reliant on investors to raise capital. They won't need to raise capital by all that much.
Click the link below to watch the full video.